Hi, I'm Lindsey, a carbon trading expert and one of ChangeBlock's AIs. Today, I will discuss best practices in carbon trading. The journey to curb carbon emissions has been marked by significant milestones and international agreements that have profoundly impacted the carbon markets. The concept of carbon credits first emerged in 1977, introducing the idea that reducing emissions could hold economic value. In 1992, the United Nations Framework Convention on Climate Change, UNFCCC, was established, setting the stage for market-based mechanisms to combat global warming. The 1998 Kyoto Protocol introduced major carbon market mechanisms, allowing countries to earn carbon credits through emission reduction projects. The expiration of the initial commitment period in 2012 highlighted the need for renewed international commitments. The 2013 second commitment period renewed confidence in the markets, leading to increased carbon credit trading. The 2015 Paris Agreement expanded the scope and participation in carbon trading, including commitments from both developed and developing countries. By 2020, the Paris Agreement fully took precedence, strengthening global carbon markets. The 2023 COP28 conference refined mechanisms governing international carbon markets, ensuring robust trading frameworks. These milestones have driven businesses and countries to invest in sustainable practices, incentivized by economic rewards for environmental stewardship. As we move forward, aligning carbon trading with a company's strategic goals is crucial, minimizing compliance costs while maximizing opportunities. Understanding a company's carbon exposure is the first step. This involves assessing their carbon footprint and determining whether the need for sustainability is voluntary or regulatory. Identifying the company's risk profile is next, whether they aim to make money, simply be greener, or achieve another goal. Finally, determining asset preference involves deciding what kind of credits to buy and why. In the voluntary carbon market, strategies are essential for companies aiming to meet their sustainability goals. Firstly, companies need to understand their carbon exposure, which involves calculating their carbon footprint and assessing their sustainability needs. This could be driven by regulatory requirements or voluntary commitments to reduce emissions. A comprehensive understanding of carbon exposure helps in setting realistic and achievable carbon reduction targets. Next, companies must evaluate their risk profile. This includes understanding whether they are looking to make a profit from carbon trading, enhance their green credentials, or achieve specific sustainability goals. Companies with a profit motive might engage in trading strategies that capitalize on price fluctuations in the carbon market. Those aiming to enhance their green credentials might focus on purchasing high-integrity credits from projects with strong environmental and social benefits. Asset preference is another critical factor. Companies need to decide what types of carbon credits to buy, whether they are interested in offsets from renewable energy projects, forestry projects, or other types of emission reduction initiatives. The choice of credits should align with the company's overall sustainability strategy and risk tolerance. A data-driven process is essential to evaluate risk and assess liquidity accurately. This forms the foundation of a robust carbon risk strategy, aligning with the company's strategic goals. Minimizing compliance costs while maximizing opportunities requires a thorough understanding of the relevant laws and frameworks. Our discussions with clients typically start with assessing risk exposure. We identify and quantify risks, then prioritize them. Selecting appropriate instruments to mitigate these risks follows. Companies with a surplus of credits face two options: selling them in the market for immediate cash, or retaining them for future use if they anticipate future shortages or believe prices will rise. These transactions are usually on a spot basis, but settlement time can vary. For allowances in the compliance markets, it's normally 2 days, but for voluntary credits, settlement can take months. However, with ChangeBlock, settlement is fast and straightforward. Strategic purchases involve assessing overall exposure, especially over a multi-year time period. Companies might buy credits and allowances on a forward basis, agreeing on a price and delivery time with the bank. Offsets can also be used for compliance if they are eligible and cheaper than allowances, thus reducing costs. For regulated companies that receive free allowances, the allowances act as assets on the balance sheet but don't provide dividends or interest. They can be used as a financing tool depending on the cost of capital and working capital costs. Selling allowances today and repurchasing them later can generate free cash flow for operations. In summary, the key to effective carbon trading is preparation. Understand the framework, assess your risks, and maximize your opportunities. Thank you for your attention. If you have any questions or need further assistance, please visit the ChangeBlock Network. ChangeBlock. See the change?